You might have the share for share under section 127 TCJ 1992.
Yep.
So, yeah, there are a few things that are sort of linked: takeovers, deferred consideration, earnouts, and share for share BADR. And yeah, that's fine. So, as normal, let's have a read of the question, discuss, and then we can talk through the answer, please.
Sure. Yeah. Just make a note of this. Agnes will. So I can make a few notes as I'm going along. So, sole director and shareholder of Woolly Limited, a textile company which manufactures items from wool, incorporated Woolly Limited on 4th of September 2007, immediately subscribed at par for 100,000 ordinary shares of £1 each. She's a high rate taxpayer. Garments PLC have recently made an offer for the entire share capital of Woolly Limited, which, if accepted, will complete by 30th of November 2021. They have offered an immediate payment of £100,000 plus some additional consideration.
Okay, just to stop you there, please. What information do we understand?
So what we've got so far, I thought I'd better stop there because then it goes into all the options. So sole director and shareholder of Woolly Limited. That the immediate things I'm thinking of there is that if there were any sale of those shares, if she's the sole shareholder, then she's likely to meet the conditions for business asset disposal relief on any disposal.
Good. Yep.
Because I suppose with mentioning the high rate taxpayer, that say normally in which case that any disposal would be taxed at 20%, but then if it were eligible for BADR, then would be taxed at the flat rate of 10%.
Agreed. And it's a textile company which manufactures items from wool. So that tells you trading.
Yep, trading. She's the sole director, so she holds more than 5% of the share capital. Easily meets that criterion. She is also, if she's director, then she's working for the company. She incorporated the company on 4th of September 2007. So if we're talking about 2021, it's certainly confirmed that she's met all the conditions for BADR for at least 2 years prior to this disposal.
And then what do we have? Garments PLC have made an offer.
Recently made the offer, yeah. So the offer of an immediate payment of £100,000 plus some additional consideration. They've given Agnes two options. Well, before going into the options, of course, the immediate payment of £100,000 makes me think that this is the cash plus whatever additional consideration might come later as per whichever of the options she chooses. That the initial cash would be immediately chargeable to capital gains tax.
Excellent. Always immediately chargeable. There's three forms of consideration that needs to be considered. One is cash, always immediately chargeable. The other is shares, whereby you either have the share for share rules applying automatically or you disapply depending on the circumstance, and you can have QCBs / loan stock. And then when you come to QCBs, it's either a qualifying or non-qualifying QCB, which has slightly different CGT implications.
Yeah, I vaguely remember some of that. That's a good note actually for me to double check some of the conditions on QCBs and stuff, because they may be exempt
Exactly.
in some instances from CGT. Yeah. So shall I move on to option one, or?
Yeah, that's fine. You can move on. I think we've covered it says will complete by 30 November 2021. So we just remember that that's the 21-22 tax year.
Yeah. So depending is that we may be advising on whichever else for 21-22, sort of looking forward. Yeah.
Exactly.
So option one, so it's the £100,000 plus additional consideration. So option one, 300,000 to be paid in equal installments over 3 years with the first installment to be paid 1 year after completion, plus 200,000 to be paid 5 years after completion, provided that Woolly Limited meets a specified profit target. Okay. So the £300,000 to be paid in equal installments. Thinking about this carefully, is that because it makes me think of, say, the CGT installments of, say, the individual is receiving the money, is receiving those proceeds over time, over a specified time period. I don't actually. I think I'm thinking of that in terms of, say, where there's CGT payments, if they're paying CGT on those, that it can be divided up. If I recall that correctly.
Okay, yeah. So you're thinking about the 18 months. If consideration,
yeah, that's it. Yeah.
If consideration is paid over more than 18 months, then you can make CGT installments make CGT payments in installments.
Mm-hmm.
So that is a good point you can make, because it does exceed 18 months. What about you would make that point. And what about the 300,000 itself? How would we sort of look at it for CGT?
Even though it's being paid in installments, recalling this correctly, that even though it's being paid in installments, is it all treated as forming part of that initial disposal in the tax year in which this disposal is taking place? So it'd be all 300,000.
Yes, agreed. So it'll be the 100,000 initially and the 300,000. Why? Mm-hmm. Because that's just the way it's treated. You know exactly what's going to be received. It's been quantified. It will be paid over 3 years. 300,000 is also added to your proceeds. And then what happens is, let's just say, for argument's sake, there was a dispute after 2 years and the Garments PLC refused to pay the final 100,000 installment. Then what you do is you just revisit the calculation and adjust the computation and reclaim your CGT that you originally paid.
I actually, in practice, I had a scenario like that where there was a deferred consideration and the company paying our client or clients, they weren't able to pay the remaining proceeds. So, as you said, is that we had to readjust the CGT calculation, and it resulted in, of course, in a smaller tax charge overall and stuff.
Therefore, a repayment, because they would have paid the full tax charge at some point. So, just a few more points on what we've just mentioned is
trying to think if there's anything else about the 300,000 or I think that might be everything on that point from what I can remember. I mean, yeah. I know the payment thing will probably come later.
Yeah, exactly. I just wanted to mention about. Yeah, I'll look into it. I've just got something up on my other laptop, but I do have another point to mention. I'm just trying to confirm it. All I want to mention is basically how you go about claiming the repayment. Do you go back and adjust the previous year's computation, or do you just claim it on the current year's tax return when you realize that the consideration will not be paid?
In practice, is that what I would have done is submit the amended return for the tax year in which the initial disposal took place.
Yeah, however, the time limit for amendment may have finished because it was...
Oh, yes, because if it's not within 12 months.
Exactly.
If it's not within 12 months, is that... isn't it...
I've got it here. Yep.
I'm trying to see if it's something in my memory joggers, because I was remembering something about 8 years, but I don't know. I don't think that's relevant. Or
no, not the 8 years. What you need to do is to carry back a loss on an earn-out right. So effectively, this is an earn-out. Not directly, but indirectly. So the individual must make an election for the loss, because effectively there's a loss of 100,000 if they don't pay the 100,000, and treated as a loss of that earlier year. So, okay, so you're correct in saying that it is treated as a loss of that earlier year. The election is an all or nothing claim. A separate election is required for each loss. The time limit for the election is 1 year from the normal filing date for the return in which the loss arose. Therefore, for a loss on disposal of a right in 1920 to be carried back, the election must be made. I think. I was just thinking that you're probably out of time to amend, so I don't know.
It's a bit of a funny one, yeah.
I'll double check what happens in practice. I don't think it's too important for your exam. However, it's good to understand exactly what's going on so you don't get confused.
Well, you never know. Something like that could turn up as an extra mark on a question. So
you're right, especially with this whole open book. They're trying to throw a few things in that are a bit more practical. So yeah. Okay, that's fine. My understanding at this moment in time is that you'd make the claim on your current year's tax return. However, that doesn't sit too well with me as well.
I'd always think of, in practice, of say the amended return, because it's say with the original return that's where the original disposal is recorded. Yeah,
I'm leaning towards that now. However, I'm just thinking about the time limits, because what about if you have an earnout over 5 years, let's say, and you find out after 5 years, then you have an issue. I think maybe it's just a matter of writing into HMRC and just sorting out like that. I think that might be the thing, but I'll double check and get back to you on
that. Okay. Shall I move on to the 200,000 bit to pay 5? Yep. Okay. Looking at that, it's a set sum, so to be paid 5 years after completion. So I would call it ascertainable deferred consideration.
Excellent. Deferred ascertainable.
Would I go in to describe then that it would be ascertainable deferred consideration because it is consideration being paid on the occurrence of a future event, such as, in this case, that the meeting the specified profit target would be considered this future event?
You could do. There's no harm in making that comment. It'll take you 30 seconds to type. So I would explain why you are saying it's deferred ascertainable. So yeah, I would definitely advise you to go on and explain why, because someone may think the 300,000 is ascertainable deferred as well, but it's not. It's two different things. So you've explained that it's based on a contingent scenario. So it's contingent consideration effectively. What would be the implications? Do we bring it in now or later?
If it were ascertainable, if the amount is fixed, then that forms part of the whole initial transaction. That also forms part of the proceeds, along with the 300,000 and the 100,000 of initial cash.
Exactly. So you'll have effectively 600,000 considerations so far for option 1. Let's move on.
Option 2, 10,000 Garment PLC shares valued at £30 per share. This will give Agnes less than 1% of the overall shareholding in Garment PLC. Agnes will receive the shares on completion, plus 5% of the Woolly Limited profits for the next 5 years, currently estimated at worth 200,000, and will be paid 5 years after completion.
Oh, yeah, I just lost it there.
I've just realized, is this the question bank I sent you, or did you already have a copy?
No, this is a question bank you sent me. Thank you very much.
Yeah. Thought it might be handy.
No, I do have a copy of an individual's question bank, but I think it's from 2019, if I'm not mistaken. Right. So obviously it's no good in terms of it's best to have the correct dates, right? The current dates.
Sure. Yeah.
Rather than confusing everyone. So thank you very much for that.
You're welcome.
So what do we have? 10,000 government PLC shares valued at £30 per share.
Okay, well, first thing I'm seeing here, of course, is that if it's the share for share exchange rule, that when it's new shares being offered for old shares, then in principle, the share for share exchange rules apply automatically, and no disposal would be deemed to be taking place. Hello?
Yeah, as in there is a disposal, but it's just there's no consideration.
No tax. Yeah,
there's
no
tax
sort of consideration there.
Yeah.
Of course, the thing that I also saw is that when looking, this will give Agnes less than 1% of the overall shareholding, because if that were the case, that with those Garment PLC shares, that when it comes to her selling those at a later date, then business asset disposal relief would not be available because it's less than 1% of the overall shareholding that she's receiving in the new company. So, of course, that rings an alarm bell, is that she could, because she would end up paying tax at 20% on a later disposal, that she can elect to disapply the share for share exchange rules.
Exactly. Under section 169Q TCJ 1992, you elect to disapply. So what that means is everything else, share for share and incorporation relief, are both automatic. So you need to disapply them after looking at the implications. And you're right, BADR will not be available. So this may be worth looking at. We're not too sure yet what's better, but it's definitely worth looking at. But we'll need to do some calculations.
Because would it say technically, because if you're including, because if it's the PLC shares, if the election, as you say, that we need to do the calculations, that it would be a larger gain if they did make the election, but of course it would all be taxed at 10%. But although it might be a smaller gain if they did not make that election, it would be taxed at 20%, depending that the 20% tax may be more than what's being paid at 10% on a larger gain.
Exactly. That's exactly what it is. And also the bottom line would be that the 10,000 government PLC shares, if you disapply, would have an uplift in base cost. Effectively.
Yes.
£30 times 10,000, which is 300,000 base cost. So on future disposal, you'll probably have you'll definitely have a smaller gain, which is at 20%. But that's still fine because it's a way smaller gain compared to original base cost.
So yeah, we'd have to do a calculation on that. So I suppose that I'd have to do a comparison with, say, what the calculation would be if the election under 169Q were made, and then a comparison with where there were no election.
Exactly. That's what you need to do. You need to do two computations. In terms of, two full computations will give you a good few marks. In terms of currently estimated to be worth 200,000 and would be paid 5 years after completion, is this ascertainable or unascertainable?
Unascertainable.
Okay, why?
Because it is an estimated value, is that it's 5% of the Woolly Limited profits for the next 5 years. Well, we don't know what exactly those profits will be. So what would be done in this case, if it's unascertainable deferred consideration, is that the estimate, what they estimate or what they project the profits to be, are included as per the Marin and Inglis principle. It's included as part of the computation.
Exactly. So when you think about it, it's unascertainable. It's not ascertainable, but the effect on the CGT computation is effectively the same, right? You still include the consideration under the Marin Inglis principle. Yeah, that's good. That's very good. Now, in terms of the final sentence, we have already used up her annual exempt amount, therefore no annual exemption. Explain the capital gains tax implications of the sale for Agnes. 15 marks. Now, there's two ways we can do this. If you like, you can share your screen and do the computation, or I can get Excel up and we can do it on my screen. It's up to you how you want to do it. The reason I'm saying if you have a go this time is I just want to see your presentation. No doubt, I think it'll be perfect, but maybe there may be one or two things I can probably comment on.
So if we were doing a comparison between the two options, so I suppose I would start with option one, going through the description and then showing a calculation.
Yep, that's correct.
Mm-hmm.
So what would we do?
Well, what I've learned from the marks teams is that, say, I'll do my analysis in whatever sentences and then do the computation, covering the points. So in terms of the actual computation, that it would be for the proceeds, I do that sort of breakdown where, say, there are two columns, and in the left column, I'll list what compiles the proceeds or what consists of the proceeds. So the cash would be 100,000.
Cash consideration.
Mm-hmm. Yep. So if it's the option one, it was the installments over 3 years, but that will be immediately chargeable to capital gains tax. That would form part of the proceeds. So 300,000 there, yeah. And then for the next bit, the ascertained consideration would be the ascertained deferred consideration of 200,000 would then be added on to form total proceeds of 600,000.
So we're adding 200,000, right, for deferred ascertainable.
Yeah. Uh-huh.
600,000. Excellent. So that's total consideration.
Yep. And that would be the total proceeds.
Yep. Mm-hmm. Yeah, total proceeds, total consideration. And what is our base cost?
Better double check that, actually. Got my
screen.
Hang on, I can pull it. Oh, sorry, yeah. You got it there. I'll pull it up on my other screen as well. So base cost. So if it were originally the 100,000 ordinary shares of £1 each from her shares for Woolly Limited, that would be the initial value used. That would be the value used for the base cost. So the base cost would be 100,000.
Excellent. On subscription of shares, 100,000. Minus there. And that gives you a capital gain of 500,000.
Mm-hmm.
Then I've got here at 20% is 100,000 CGTG.
Mm-hmm.
Straightforward, right?
Mm-hmm. Would it be 20%? Or would there still be the BAGR?
Sorry, yep, you're right. So that's 50,000. And then in your this is just the calculation. In your answer, you'll have a few notes. So note number one. So let's just talk through the notes you'll have. What would you say for each item?
So what I was thinking was that how I'd have thought of presenting it as notes sort of at the top, and then go into the computation, just explaining it first. I mean, I don't know if it makes a difference which order you do it in, as long as you do it.
Exactly. It's fine.
Yeah. So note one, the cash consideration is any cash received is immediately chargeable to capital gains tax in the year that the disposal takes place. So in this case, would it be 2021-22 if it's November or? Yeah.
Exactly. Yep.
Mm-hmm.
Yeah.
Trying to find the question now. I've got it here somewhere.
Oh, sorry.
No, it's fine. I've got it on my screen, so it can help me look. Yeah, here we go. I've got a PDF on my other screen.
Nice.
Yeah. That's cool. That makes sense. So note 1 would be cash consideration immediately chargeable in 2021-22. Note 2 on the deferred installments, even though paid in installments, the full proceeds would be chargeable to capital gains tax in the year of disposal, forming part of the total proceeds.
Perfect.
And
Effectively,
then,
I think we've spoken about this already,
sorry,
right? Yeah, we've
Yeah.
already sort of discussed it, so that's good. And then deferred ascertainable, you already mentioned that it'd be brought in now again. However, changes would be made if the 200,000 was.
If they couldn't pay all the proceeds, yeah.
And note 4, you what would you say for note 4? Why would it be 10%? You already mentioned, but just very quickly.
Business asset disposal relief should meet all the conditions, having held the shares for at least 2 years prior to disposal in a trading company. She's a director of the company for at least 2 years, and holds over 5% of the share capital.
So then 10%, that's fine. Good. Let's move on to the next computation. So
this is where the fun begins. So starting off with the first bit on the £10,000 Garment PLC shares. So of course, I'd explain at the top that an election may apply here to have the gain taxed in the initial year of disposal, disapplying the share for share exchange rules under 169Q, because a later disposal would not qualify for BADR and would be taxed at 20%.
Yep. In terms of time limits, when should the claim be made with the election?
Good question. I'm trying to remember that now.
You'll have it in front of you anyway, but the answer is it's the anniversary of 31st Jan following.
First year following.
Exactly. The 12 months following 31st Jan, following the year of disposal or exchange.
Year of disposal. So it would be, in this case, if it were 21-22, it's the first year, 1st of January following disposal. So it would be 31st of January 2024.
Excellent. Spot on. That's perfect. Yep. So that you'll definitely get a mark for that. So that's easy mark there. And yeah, so yeah, I've definitely understood what you're saying, and it's very clear what you've explained. You're saying that it's the whole question of BADR not available in the future. Therefore, what would be better? Now, in terms of calculations, let's do 2 calculations.
Yep.
On option 2, let's do one with the election. Let's start without the election, because that's automatic, right? So
okay.
What is so we have the cash consideration of 100,000. That's always
100,000. Yeah. So if it's the looking at the question again. Okay, so if there were no election, then the Garment PLC shares, there will be no taxable value there. It'd be nil, technically.
Yep, perfect.
And then just going through the rest. And if it's the unascertainable consideration, then if it's that estimated value, then that would be 200K. Forming part of the proceeds.
Yep. That's fine, I think. We have 300,000 total consideration. Total consideration. And then base cost.
Let me check that. Would it? I feel like there's a catch here or something, but would it still be the 100,000 as per, say, the original base cost of the shares in Woolly Limited?
Yeah, it would be the 100,000 as a starting point, but it'd be apportioned, right? So
Yes.
let's just say total base cost is 100,000.
Mm.
So if you look at percentages, this is total consideration is 300,000.
Mm.
So, however, is actually 600,000. Why? Because we have 200, 300, which is the 10,000 shares at £30 each. Are you happy with that?
Yeah, that makes sense.
And then you have 100,000. So then we say, in terms of percentage, this is 1/6. Oh no.
Yeah, fun with Excel where the whatever grid, the thing at the top.
I'm just going
Can't
to
change
say
to fractional percentage.
exactly. I'm just going to say this is 50%. This is 33%. And this is the balance of 17%.
Mm-hmm.
So our base cost of 100,000 needs to be apportioned. We are only taking 50% of base cost because the balance of the base cost, which is 50,000, would be used against disposal of the Government PLC shares in the future.
Right. So if it's 50%, the 33 and the 17%. So would it be 100,000 times?
Ignoring the percentages, you do 100,000 times the 100 plus the 200.
200. So the 300 over the 600.
Exactly.
Got it.
That gives you £50,000. Therefore, your amount subject to capital gains tax will be 250,000. Will BADR be available or not?
On this disposal, yes. So 25k.
Notes. I will have a note here, just showing this part here.
Mm-hmm.
I'll have note 2. I'll have note 3 with just explaining, and note 4 again.
Mm.
Any questions?
No, that makes sense to me. It's just remembering that catch about apportioning the base costs, which actually I'll make a note of that. Apart from that, all makes sense.
Excellent. Let's move on to the next computation, which would be, so this was under no election.
Mm-hmm.
And then we have section 169Q, TCGA 1992.
Mm-hmm.
Election.
So
consideration is always there.
Yep, 100,000. And then because we're treating the shares as well, we're disapplying the share exchange rules. So a taxable amount is arising here. So the 300,000 for the Garment PLC shares.
Yep.
Mm-hmm. And then the unascertainable consideration for 200k.
Yep, that gives us 600,000 this time. Previously we had 300,000. Now we have the full 600,000. Base cost would be?
Just treading carefully here, because if all of the items, so to speak, are being included in the proceeds, so it will be the full base cost of 100,000.
Exactly. So there's nothing being carried forward effectively. So full base cost. You don't need to carry forward any base cost. Everything has been sort of disposed and collected. So therefore, our capital gain will be
500,000.
500,000. Yep.
And if we're doing the election here so that we get business asset disposal relief on that, then it will be taxed at 10%. So 50,000.
Excellent. And what comment can we make about the government PLC shares?
As in the note, that if we're electing to disapply the share-for-share exchange rules, then that's giving rise to the full a taxable amount there. But remembering your point you said earlier about how it affects the base cost of a later disposal.
Yep. Yeah. Base cost will be 300,000 rather than 50,000, as we saw without election. As we saw above, we said the base cost here to be offset against the government PLC shares is the balance of the 50,000 on the 100, which is 50,000. But here the base cost will be 300,000 rather than 50,000. Therefore, so let's just say she disposed of it a year later. Market value has not increased that much. Let's just say increased to 350,000. You'd only be taxable on 50,000. However, if she disposed of
20%.
At 20%, exactly. 50,000 at 20%. However, if she didn't make the election and she disposed of it a year later for market value 350,000, she would be subject to 20% again, but on 300,000.
Right, yeah.
Which is 350 less than 50,000 without the election. Does that make sense?
Yep.
Yeah, I think that covers it. In terms of you've already mentioned the Maron v. Engels principle, and I'm just thinking. We said the deferred ascertainable. So that's what we're looking at. What did we mention? We said if she. I've got it here. I've found it now. It says, yeah, you would carry back if you receive less than the 200,000. You would make an election to carry back against the year in which the original gain arose. So that confirms it. So not to confuse you, I know I was saying that the issue with amending and things like that, but it's an actual separate election where you carry back the loss.
Just quickly looking for that. It rings a bell that
Just got here the 200,000 paid after 5 years, or 5 years after.
TCGA 279A.
Okay, what does it say?
Your point that the loss on the disposal of the earn outright can be carried back to a year in which the gain on the original asset accrued. Must make an election all or nothing claim. Time limit for the election is 1 year from the normal filing date for the return of the year in which the loss arose. So yeah, exactly as you said.
What is it called? Section 279A. TCGA.
Yeah,
and then
TCGA
it goes,
1992.
Yeah, excellent. I've got it here now. Yeah, so all or nothing, separate election is required for each loss, treated as a loss of the earlier year. The time limit for the election is 1 year from the normal filing date. There is no restriction on, so this answers your question. There is no restriction on how far the loss can be carried back.
Right. Okay.
Yeah. I've actually wrote an ebook on capital gains tax. So that's what I'm looking at.
Okay.
Yeah, I've written an ebook. It's just answering the 10 common questions for all the taxes. So I've written a few, but the CGT one, I remember I covered this. So yeah, so there's no restriction on how far the loss can be carried back. The gain must have resulted in a CGT liability in that earlier tax year. This means that in most instances, the election to carry back the loss will generate a CGT repayment. If the loss is not completely used up against the gain on the original asset, it can be carried forward. So we said it's all or nothing, but if it's not completely used up, it can be carried forward. Any excess losses cannot be used against general capital gains. Instead, any remaining loss can only be set against gains arising on the disposal of the original asset. So this will only happen if there was a part disposal of the original asset in the first place. So there's potential that the loss can be wasted or partially wasted if it cannot be fully utilized against the disposal of the original asset. Is that making sense?
Yeah.
Yeah, that's fine. And then I've made a comment on EIS or VCT reinvestment. So yeah, that's fine. No, that's fine. So yeah, effectively, no, that's quite good. That's good. So you found sections 279. I did have it here as well, but I just didn't look properly. And it says special rules. So it's a special rule going back to the year of original disposal. Is there anything else that we need to comment on? What are your thoughts? Anything else to comment on?
On the face of it, no. I'm just having a quick look through. Yeah, we covered all that on the business asset disposal relief. Oh yeah, this didn't come up in this question. I've just found the last bit in the topic in the chapter about earnout satisfied by loan notes. I know it doesn't apply here to this question, but
no, let's talk about it. Go for it.
Just having a look through it. We treat the earnout as a security. Share exchange rules apply. No gain is charged. Okay, that makes sense. If it is eventually satisfied by loan notes, disposal of the earnout right, vaguely remembering this, is that if it's QCBs, this is actually what you were mentioning again before about the exemption. If it's not QCBs, treated as shares, should apply.
Yeah, it's effectively frozen and comes into charge on disposal of the loan note. So it's frozen. When it comes to QCBs, it's either exempt or frozen. And if it's frozen, when does it crystallize? It crystallizes on the disposal of the loan notes. So effectively similar to share for share when you think about it.
Yeah. So sounds a bit like that. The gain will be frozen until sold or redeemed. Yeah, got it. Where's my highlighter? Oh, there it is. See if this is anything else. Oh yes, no business asset disposal relief available. No investors relief available either. Gain relates to the disposal either the earnout of the non-QCB, not the original shares.
Exactly. Yep. That makes sense.
Yeah, I think so. Yeah. Because it's a new set of shares or say securities. Yeah. I think I understand it. Yeah.
No, that's good. So I think the main thing with the positive thing from your side is your understanding. The understanding, meaning you're understanding why things are happening, like or the principles behind these implications. It's not like you're just trying to memorize and learn a set of rules. You are sort of following the whole process through. I always mention to tax students that taxation is not. We're not just learning this for the sake of it. Tax is actually very important when it comes to economics. The governments, they control the finances of the country using two things. One is interest rates, the other is taxation. So we need to understand that everything that we study, there's a bigger reason for it. Sometimes when we're just studying, we start thinking like, or even in practice, you just think very specifically about tax itself. But there's a reason for it. For example, we said business investment relief. Why is that there? Because the government wants to incentivize investments into the UK, for example. So there's a reason behind everything. And I think you've understood the whole process and the concept, which is quite good. In terms of anything else that we need to look at, I think for this question, it's quite comprehensive. Do you have any other general questions that you just want to discuss or talk about?
What, on any other topics, or
we've got a few minutes, so I don't think there's anything further about. I think it's very comprehensive. Everything we've mentioned is completely comprehensive. Just make sure you on the share for share, whenever you have share for share, you have to ensure that the base cost is apportioned. Because if you have share for share, then a portion of the base cost will need to remain to offset against the disposal of the shares in the future. So that's what you need to always consider. That's why we apportioned our base cost to 50,000 and not 100,000.
Yeah, I had an alarm bell sort of ringing somewhere, but I was trying to remember what exactly it was. Is that I'll do a flashcard on that to remind myself, because I could have been caught out by that. Just thinking about, say, responding to your general question on any other topics, because I went back through the transfer of assets abroad and had a look at that question from my pre-revision mock. What was encouraging was that from my script, I'd started off on the right lines, but I was struggling a bit to sort of fully understand how it had worked. And I'd found another question in my revision bank, which allowed me to, I think it was question 13, which allowed me to sort of explore it a bit more.
Excellent.
Because I thought, I've got to test myself on this, because it's one of those topics where I thought, I'm not going to find out more unless I actually practice the question. And I find the mark schemes actually lay out the rules quite well for sort of future reference.
Yeah, you know what? Like, honestly speaking, if one was to simply, obviously you need to go through the manuals, but after doing the 4-day session with Tollies, for example, if one was to simply just go through all the past paper questions and use the mark scheme to the fullest, that would literally suffice. The mark scheme is a very good revision tool. Many students don't realize that. I think the mark scheme should be used. Is this your first sitting of this individual paper?
Yeah, it is. Is that
good? Very good.
Something I actually did was a kind of flashcard where explaining rules on, say, anti-avoidance questions and sort of thinking how to structure my answer. That because I've seen this sort of generally, sort of how it sort of asks you to when it's saying explain the provisions. That what I try to do is that first sort of lay out a purpose. So the aim is to say catch any transactions, any transfer of assets abroad by a UK resident person by which they obtain a tax advantage. Then go through the general rules, any exemptions, how it may apply to this scenario here.